A previous employee of Canada's bank regulator is saying that Canada should prepare for bank collapses and bank runs. So are they right? And is there massive stress in the financial system right now? Is it too late for that? As we've been discussing many times on this channel, what is happening with the banks? We know that their assets are comprising of what, guys? They're comprising mostly of mortgage debt and debt lent out to businesses, a lot of which has been sunk into, guess what? Real estate. So a lot of the debt in the Canadian economy is not diversified. It is purely just going into real estate. And that is besides the $2.19 trillion, as you can see on this chart, in mortgage debt. Obviously, the bubble started around 2003, 2004, went parabolic. This is where you saw mortgage debt grow way more than incomes have grown. And right now, it stands at 2.19 trillion, according to the latest data. That's more than the entire GDP of Canada. So obviously, huge ramifications if people start to default, and they are starting to default. We know the trend is higher and higher. It's a low number, but the trend is absolutely skyrocketing right now. We've seen it many times. I've showed it on this channel. Foreclosures are on their way up. You're seeing that happen in Ontario, Alberta, British Columbia. More and more distress is out there, and we're going to examine it in this video. So Canadian banks have been considered mostly risk-free for a long time, but every streak ends. Yeah, this is very true. A former Canadian banking regulator urges the country's policymakers to prepare for that day while it still can. In a new report from CD Howe, a former OSFI manager urges the country to modernize its banking crisis response and adopt more prudent measures. Failing to do so can result in a major hit to the country's financial stability, resulting in a wide range of issues from bank runs to outright collapses of financial institutions. As unlikely as this sounds, it comes after the recent wave of global financial institutions that were believed to be invincible collapsed over a few months. Policymakers were left claiming no one saw it coming, but were they even looking? Very true, because on this channel we've highlighted the risk in the banking system time and time again, and people have brushed it aside, said there's nothing to worry about, our banks are rock solid, and we've seen multiple financial institutions fail, and we still have right now things happening in the repo market that look incredibly suspicious. Again, you saw repo volumes that just happened on October 16th, so just last week, repo volumes absolutely skyrocketed after the latest inflation data came out. So that was after markets anticipated even more rate cuts, and these rate cuts, we're led to believe, although we know it's not true, are meant to be the thing that is just going to make this economy absolutely boom. Obviously, we know that's not the case on this channel. We know how much the economy has just been crushed and crushed and crushed and crushed, and people are essentially living in this recession and like zombies are heading into a depression, just completely unaware of what's going on. And it will be just like after the financial crisis for over a decade, where countries like the UK, where I'm from, were just absolutely destroyed by it and still have not recovered to this day. So you can see the repo volumes absolutely explode. If you go back to earlier just this year, repo volumes were way less, and they've more than doubled since then. So you're seeing basically more financial institutions, chartered financial institutions, that don't want to lend in the safe and liquid repo market. And you've got more chartered financial institutions that are looking for cash. They're out there in the repo market and they just want cash, and they're exchanging these safe assets, quote unquote safe assets, like government bonds. And guess what? Other banks, they don't want to do the exchange. So when banks are needing cash really, really quickly, obviously that is not a good sign. So it's very interesting that this report comes out, but I think it's too little too late. And obviously policymakers are stupid, dumb, and slow in Canada. Reimbursement acceleration is also of concern. The CDIC currently currently aims for reimbursement within 3 business days. But once again, they haven't been tested recently. This also factors into another one of their suggestions. Regulators need to plan for the potential failure of multiple institutions simultaneously. So let's just play out a scenario. Let's just say Bank of Montreal goes bust. That means you're not getting your money for a minimum of 3 days, according to Canadian Deposit Insurance Compensation Scheme. And even if that happens after 3 days, which obviously it would, where's that money coming from? Obviously, CDIC hasn't got hundreds and hundreds of billions of dollars just lying around that they can put into it. Where are they going to get it? Obviously, they're going to get it from the government. How's the government going to get it? They're going to print into deficits. They're going to inflate essentially the currency away even more. So these things have wider ramifications. People think just increase that deposit insurance, everything's going to be fine. But where's the money that is backing that up? Because there's not enough money there, even if one of these huge financial institutions in Canada goes bust right now. So you have to be aware. Beyond the global banking issues, there are some early signs of financial stress in the system. The Bank of Canada recently made a significant increase to its short-term liquidity facilities, and this is right here. Effective Monday, July 15th, dealer limits for overnight repo operations will increase to $3 billion for each eligible participant from the previous $1 billion. So that's obviously huge increase there, tripling. And basically, it's not a good sign, is it, in the repo market? If they're having to do that, it shows that more and more cash is needed. These banks are extremely levered in Canada. People think they're solid, but all financial institutions globally, pretty much in the Western countries, are all really, really leveraged. It's just important to be diversified, have bank accounts in different countries, different currencies. It's just a good idea. It's good practice. Obviously, in Canada, because of the relationship with the United States, it's very, very simple and easy as a Canadian to go and open an account in the United States. And then you've got the FDIC insurance. The United States is a little bit different as well because they have the reserve currency as well. So obviously the United States is in a little bit of a different situation when it comes to money printing. Obviously it does affect it domestically within the United States when that happens. But if you're outside of the United States and you're not living there, it's not going to affect you so much. So I would just recommend have bank accounts, be diversified, don't have all your eggs in one basket. There are so many Canadians that just have one bank account and they have everything with one financial institution. And just saying that makes me nervous, but it is such a common occurrence throughout Canada, and I have no idea why. It's just completely insane. I want to show you something as well. So debt to GDP, you guys who have followed this channel for a long time will know this. Debt to GDP peaked here. If you compare this to the United States in 2008, so we pull this out, you saw a similar peak that happened here, and it actually started to happen before the global financial crisis, which would make sense because the financial crisis is on the way in Canada, and you've seen this peak out, which happened in actually 2020, and you've seen debt to GDP that has gone down. So it's very interesting when you compare that to obviously what's happened in the United States with debt to GDP going down. And obviously this mortgage debt right here, you've got to realize these are the people that you are balancing that debt on their back. Are they going to pay? Do you think that they're really capable of paying? With all these surveys that come out and people brush them aside, they say, oh, we see these things every year. But you're seeing more and more now the economy deteriorate, unemployment go up, which means people, they have no choice. They have to default. You see more and more that people, when they have no choice, they're going to default on their debts. Their debts are huge in Canada. So Canadians are making tough choices to manage the high cost of living, with half, 51%, reportedly changing their spending behavior to make ends meet and save money, according to a survey by insolvency practice M&MP. So obviously, if people are changing their spending habits, that's going to have ramifications for the economy, and obviously we know that's happening. So under the burden of inflation, Canadians have been finding ways to share expenses, with nearly a third saying they have turned to bill splitting strategies. These include carpooling, buying in bulk, sharing subscriptions, childcare, co-inhabiting with others. So obviously, again, this is just showing you standard of living going down. down. That's pretty much what's summed up there. Even though inflation has come down to 1.6%, interest rates have come down, still people's backs against the walls. They just cannot afford it. So MNP's quarterly consumer debt index released Wednesday also found that 28% of Canadians have even resorted to eating less to save money. I mean, that is something that you would not expect to hear unless a country was in a depression. I mean, 28% of people who are eating less because they just can't afford it. I mean, that is third world. That is really third world. These measures reflect the harsh reality of soaring living costs, compelling Canadians to find new ways to save. The report further highlighted that Canadians are cutting back on discretionary spending. 51% say they have tried to save money by grocery shopping more strategically, while 48% are avoiding impulse purchases. 44% say they have stopped going to restaurants or ordering takeout. Such cost-saving measures are common among Canadians between the ages 18 and 34 and those living in British Columbia, Alberta, the report said. So very interesting, especially interesting with everything that's been going on in Alberta and the videos that I've done recently on that. It's interesting because you're looking at a consumer that is more and more stretched, and these reports, they give us insight to where the economy is heading. Obviously, if consumers are cutting back more and more on their spending, well, what's going to happen to the economy, folks? It really does not take a genius to work out that the economy is going to be heading down and off a cliff, because that's what the economy is built of. And obviously the housing market is massively impacting stuff because you've got declines in the biggest markets right now, and eventually that's going to filter into everything else. You've got unemployment that's going up. So these rate cuts, they really make no difference. Obviously we've got another Bank of Canada announcement, so stay tuned to the channel for that. We'll continue to monitor what goes on there. Anyway, guys, if you've really enjoyed this video, I'd highly recommend that you can do me a favor, check out this video here. If you're looking for a VPN, you know where to go. Use the affiliate link in the description. It helps out the channel. expressvpn.com/marketmania. I will see you in the next one. Take